History is in the making. The S&P 500 is at the brink of closing at the historic 5,000 level. And we need to talk about what happens at these 1,000 increments and should we be a little worried. Today, I'm going to bring you the stats since 1950 to show you the good and the bad and everything that happens in the S&P 500. But more importantly, we need to talk about earnings. PayPal reported earnings and it took a nosedive in after hours, completely shocking the world, and I'm going to give you my take. But we also need to talk about dark pool activity. There is some major flows happening under the hood that we need to talk about. And of course, we need to discuss that 10-year bond auction. So join us today as we talk about stocks and the financial markets together. Hello, ladies and gentlemen. Welcome to the Daily Recap Show. My name is Chase. We do these videos every single day. We talk about stocks and the financial markets. I give you the recaps, trade ideas, and everything in between. So hit that subscribe button, like this video. Let's get into it. Today was risk on. That dip in semiconductors got bought yesterday. Kind of crazy. The bullish sentiment and conviction in this sector is so great, but technology did well, software did well. Apple didn't participate, but they did win yesterday, much to be expected. They were flat on the day, but it was all mega caps, guys. Microsoft, Amazon, Tesla, Home Depot, Eli Lilly, United Health, Google, Meta, all of these big names really outperforming. Financials put up a pretty good day. Still a bit of stress in regionals. Now have a look at this section right here in the heat map. They were very half and half, mixed and mixed, and that's just because rates went up on the day. And a lot of these are just really rate sensitive names, and that's why it was very half and half. The real winners in here were the companies with great balance sheets. What people didn't want anything of is telecom services and defensives. It was all risk on. And we know this because Costco is actually a growth stock, and we could see that it outperformed. So it was growth over value, growth over defensives today. Looking at breadth, 311 winners, 190 losers. Not much to say, especially when the big boys are in the winning column. You really get outsized returns. And the market has been on quite a roll. 14 out of 15 weeks have been positive. And if we close above 49.58 on Friday, we will have 14 weeks of gains. These are the returns we can expect. Now, there's only 4 data points. It's not statistically significant. For that to happen, we need 30 data points. Nonetheless, let's look at the data and see what we can ascertain. 12 months later, average returns 6%, median returns 8.45%, 75% of the time positive. Only negative year was 1957. That being said, we could see here that 1 month, 3 month, and 6 months on, we actually get very muted returns, less than 1.65%. So what is this telling us? It's probably very choppy action in the first 6 months, and then the next 6 months is where we get our outsized returns, anywhere from 5.95 to 8.45% median. So we're going to be looking for dip buying opportunities as well as weather the volatility storm that does occur in the first 6 months after 14 weeks of gains. Moving on, looking at the majors, and yeah, the Nasdaq outperformed. You saw tech and semis were the winners, and the Nasdaq is 30% semiconductors, 50% technology, and this is where we are right now. 1.07% in the Nasdaq, 0.8% in the S&P 500. The RSP did participate too. IWM and TLT, because yields rose, bonds were down, IWM was down, and a lot of this was because of regional banks. There was some very volatile action in regional banks, and the IWM is 16% regional banks and financial stocks. And looking at the majors, you could see right here, regional banks at one point down nearly 2.5%. Then NYCB, they came out and said, we've seen zero client outflows, our liquidity strong, blah, blah, blah. And investors liked that sentiment. Actually were positive on the day, did finish negative, however, negative 0.28%. And guys, one thing I do want you guys to watch is also real estate. Real estate, this sector here is heavily levered to commercial, which is heavily levered to regional banks. So if we are going to get a CRE recession or a commercial real estate downturn in regional banks, expect this ETF to go down with it. That being said, GDX was also a loser, as well as staples. You know, these defensive names, you could see that utilities in there as well. These sectors didn't perform the best. Other than that, it was pretty bullish sentiment across the board, from energy all the way to semiconductors, software in a very close second place, home construction and technology, discretionary. And these are all just like risk on names. Financials as a whole bucking the regional bank trend. And that's because, you know, bigger financials, and that's because if these regional banks are to fail, these bigger financials are going to step in and just pick them up for pennies on the dollar. Now, looking at investor outflows, this is both his clients by sectors. Com services saw the biggest inflows, real estate saw saw the biggest outflows, and we know why. We just spoke about that recently. All in all, both the clients were net buyers last week of stocks, mostly in comp services and ETFs. Look at what they sold though: real estate, tech, materials, staples, mixed in all the other sectors. But all in all, both the clients were net buyers. Now let's talk earnings. So we had some pretty big names report earnings: Uber, Baba, PayPal. I haven't looked at ARM's earnings, but they were up 20% after hours. So there's something good going on there. I might discuss them in tomorrow's video. Disney were up 7% in after hours. Probably when you see that type of sentiment, it's probably a mix of good guidance and just good metrics for the year. Now let's talk Alibaba, Uber, PayPal. Uber put out actually really good earnings, but what the market didn't like was the guidance. You could see here that gross bookings rose 22% year over year to 37.6 billion, but that's about what they guided for in financial year 2024. And the market always wants growth. That being said, they beat EPS, beat operational cash flow. It was actually a stellar quarter for Uber. It's just that guidance, like maybe growth could finally be slowing, and is that valuation now justified? Alibaba, I briefly went over it. They're doing a $25 billion share buyback. That's 18% of the market cap. But all in all, guidance was very, very light. Free cash flow was light. Not much to love in Baba, but at the prices it is, still great value. You're literally getting a company that's giving its money back to its shareholders in buybacks, in dividends. PayPal, this is probably the one you all want to look at. Yeah, they beat on revenue and they beat on EPS by 13 cents, but the guidance though, 40% short of what the street expected. They are doing $5 billion in share repurchases, and they did guide for at least $5 billion in free cash flow. And the street didn't like it. The street didn't like it. To be honest, I think the stock is now probably going to go to like the 50 area, maybe even as low as 45. That's what I think is going to happen. I have a feeling that management is just saying this to lower expectations because stock is already so beaten down and they're going to absolutely come in with a beat. That being said, that is the guidance we have to look at right now. But management did guide for at least $5 billion in free cash flow for 2024. And if we use this number right here and we actually use their effective growth rate in 2024, which was 13%, right? Let's go plug in the numbers and see what PayPal is actually valued at right now. Now, here's a discounted cash flow for PayPal. We can see here that this was the free cash flow that they reported in their earnings report today. 4,554, so $4.5 billion. I put a growth rate of 8% just to build a bit of margin of safety. If we discount those future cash flows using an 8% growth rate, an 11% discount rate, 2% perpetual rate, and we get a terminal value right here. Now I used $11.8 billion in cash and cash equivalents, $10.5 billion in total debt, and pretty much a billion shares outstanding. Do take into consideration they're going to buy back $5 billion. We get a fair value of $88.6. So the stock is still well under fair value as we speak. If we actually use the 5 billion number that they guided for in 2024, we can see that PayPal's fair value is $97.23. And if we actually use the effective growth rate for 2023, which was about 13, let's just say 12, we can actually see that PayPal's fair value is $114. So that being said, at the current price, I do think that PayPal is a good buy if you look at it purely on valuation. But the truth is the market now needs to figure out, what does a decrease in EPS mean? That's what the market needs to figure out. Is this management trying to lower expectations, or is there something devious going on in the books that we're not aware of? I haven't dove into the annual reports as yet. I haven't looked into it as a whole, but definitely something underlying that I'll probably tackle on my Twitter over the next couple of days. So go ahead and follow me on X or Twitter, whatever they're calling it now, and I'll give you the full inside scoop and rundown of PayPal. Now, I showed you guys this chart yesterday. It's the swig breadth thrust, the ZBT, and essentially it's just the returns after stocks go from extremely oversold to overbought conditions. Now I have another price thrust for you guys. This is the rolling 3-month price thrust after the S&P 500 returns 15% or more in that 3-month period. We've had 36 instances of this occurring, and 12 months later you can expect 11% average returns, 28 wins, 8 losses. And the returns tend to be very linear. You could see 1 month on 0.49%, 13 weeks on, 3 months on, pretty much 3%, 6 months on, 6.28%. So very linear returns we can expect over the next 12 months, especially considering the fact that this actually occurred on the 23rd of January. So very positive if you think about it. All of the thrust and breadth thrusts are seeing, yeah, we can actually get some weakness in the first 4 weeks, as you can see right here, we do get quite a bit of weakness, but these are all just dip buying opportunities for the draw up, which tends to be very positive and not reflective of the average return. And have a look right here. You can normally see that we normally get weakness in the first 4 weeks, and then after that, the opportunity is actually really great to buy the dip. So what are we looking for? Dip buying opportunities in the next 1 to 3 months. Now let's talk earnings. Now something we need to talk about is buybacks. Something that you guys may or may not know is that 40% or like 35 to 40% of S&P 500 returns since 2011 are driven by buybacks, and corporates know that, and that's why corporates are buying back stock at such an incredible rate. The 4-week average corporate buyback is well above the historical average and just history in general. And we've seen this change occur over the years. Companies have favored buybacks more and more over dividends, as they do know that it's as they start to realize that buybacks create more value for shareholders. We could see here that in 1995, 63% of companies paid a dividend, only 3% bought back stock. Today, that has entirely flipped. 66% pay dividends, 70% buy back stock. And growth-oriented sectors typically favor buybacks. We can see that comp services, tech, healthcare are the ones buying back the most stock, paying dividends too, but in comparison to something like utilities, real estate, which 98% pay a dividend and only 29% of companies buy back stock, it's a stark difference. And this is why growth has actually outperformed value in the last 10 years. And at the same time, companies are actually growing earnings. The latest S&P 500 earnings stat for this earnings season is 5.6%. Year-over-year earnings growth of 5.6%. Excluding financials and energy, we're looking at 10.2%. Double-digit growth so far for the index. Very healthy returns. And continuing on with corporate strength, these are liquidity metrics. So it's non-financial and non-utility US issuers. We could see here that in the last 12 months, companies have increased their cash holdings and decreased their long-term debt. What does that do? That just literally strengthens their balance sheet. So long-term debt decreased, cash increased, and hopefully this trend does continue. I think that now as interest rates continue to be higher for longer, we might actually see a continued trend of this, just companies slimming down their balance sheet in terms of the debt and shoring up cash, especially as they do know that buybacks and dividends need to be paid to shareholders. And looking at interest coverage ratio, we're starting to see a tick up in companies paying down their debt, which means their interest coverage ratio is a lot lower. And since 1999-2000, we've actually seen a very stable trend of higher highs, higher lows right here. Now, we did actually break the low right here when rates were at zero, but the second rate started to move up because of the COVID situation and taming inflation. Companies did the right thing and they started decreasing the amount of debt on their balance sheet. As a whole, based on earnings, based on all of these ratios, the median coverage ratio, debt and cash balances I've just shown you, US companies are getting stronger by the year. Now let's talk about the US consumer. Very much the same thing. We can see here that total balances by delinquency status has been ticking up over the last few quarters, but still at historically low levels. Keeping up with this theme, we can see here that credit card debt as a percentage of disposable income is sitting at 5.5%, well below the pre-pandemic average. And a lot of people always say that US borrowers are maxing out their credit cards. They're simply not. We can actually see here that the pre-pandemic average, so this is the percent available for credit, is at about 24%, and this is where we're sitting at right now. It's looking a bit more grim for home equity, sitting at 39%. The pre-pandemic average used to be 51%, but we are starting to see an improvement in this. Now, looking at the economy too, we are seeing acceleration in the economy. The Atlanta Fed's GDP now is sitting at 4.2%, and this number is a bit worrying because the economy can start to overheat and that will reignite inflation. That being said, companies are strong, consumers are strong, the economy is growing strongly. These are very, very good signs for higher stock prices and higher stock returns and just higher asset prices 12, 24 months down the track. Now let's talk about the 10-year bond auction. Now we got the 10-year bond auction today, guys, and it was very good. There was solid demand. Yields did increase though, but I think that has less to do with what the 10-year did and how we're pushing rate cuts out further to May to June, further out in the year. The auction was for $42 billion. It was the biggest 10-year treasury ever, and it was awarded at 4.093, below the pre-sale rate. So a very, very strong auction. And I got some data here for you guys. So this is US 10-year yield average trend analysis since 1963. The average trend of a 10-year yield is up into May and down into year end. When January is up, average trend is up more and longer into August and September, then lower into Q4. When Jan is up in year 4, yields rose sharply in Jan to April. So what we're seeing in the 10-year yield is completely normal. What we normally see is an increase, bit of consolidation, and then a decrease through the rest of the year. Now let's talk seasonality. This is the average seasonality performance for February since 1950. This is what we're doing right now. Now the scales are different. Do take that into consideration. That being said, we are kind of following the average seasonal performance for February based on the historical trend. And if history is to repeat itself, we should see a dip over the next few days, find a bottom, and then rally all the way to OPEX before we do go ahead and sell down into the rest of February. Now February normally actually has a negative return since 1950, and this is completely normal even in a presidential year. This is the average return since 1928 in a presidential year, and February normally returns negative 0.31%, and generally speaking Q1, Q2 tends to be typically weak. What we really want to do is find a bottom maybe around the April, May area for the end of year rally that ensues, and this normally happens because the market is trying to price in uncertainty. When they do get certainty in terms of who's going to be the primary candidate, who's in the lead in the polls, who's president, that's when the market starts to rally. The market does climb the wall of worry, but once it gets certainty, it tends to do even better. Now let's look at gamma. There are a few changes in the gamma profile, but overall, we're still seeing the core gamma resistance at the 5,000 strike. The gamma flip zone, this pink line right here where we go into negative gamma, continues to be at 48.70. What we are starting to see is negative gamma build out above this strike, which means this is going to continue to move higher. And as the core gamma resistance hasn't moved up, that could be a bit troubling, because when we do get into a negative gamma environment, we do know that dealers follow the trend of the market. They buy into buying and sell into selling. So with this node, there's definitely some bearish sentiment forming in the tape. That being said, overall in the SPX, the gamma condition is positive. Now let's actually go into the QQQ. We can actually see a far different story. Now 440 is the core gamma resistance in the QQQ, but we see a lot more negative gamma, with 390 being the put support strike, and the current spot price is sitting right above this gamma flip zone. So one thing I am wary of, if we are to see a turn in the market, it might be led by the names in the QQQ. That being said, if you actually have a look at the 420 strike, there is a bit of positive gamma right there and a little bit there. So if the market is to get into this negative gamma zone, there is quite a bit of support that could form at the 420, 410 level. That being said, this 424 is absolutely key for the Qs to hold, to keep in this positive gamma condition. Now, before we get into the charts, let's actually have a look at some breadth metrics. Now, this is new highs and new lows breadth heat map. So how many percentage of stocks in the large cap, mid caps, and small caps are currently at 1 month lows? And you could see that 5 days ago, 6 days ago, 7 days ago, this number was less than 3%, and we've actually seen an increase in the number of 1 month lows. The same is true for mid caps, and the same is true for small caps. So there's definitely some changes happening under the hood with breadth, with gamma, that we just want to be wary of as we go into this February period, as we approach that key OPEX seasonal level in the February seasonal performance chart I showed you earlier. And not to confuse anybody, these are just the short-term breadth momentum metrics. If we actually look at the longer-term new highs for both large caps, mid caps, and even smalls, you see very, very positive statistics. And these longer-term metrics are the ones that really matter. Now, this is the SPY. These are dark pools right here, guys. Now, these green lines right here, these are signature prints. If you don't know what they are, the big boys, market makers, the big players, route their orders through Europe so they don't have to report it on the day. They only have to report it 24 hours later. And this is why it showed up on the chart 24 hours later. This actually is not the chart of today's trade. It's of yesterday's trade, but it only shows up on the dark pool activity today because of how they routed the orders. These were placed right here, and we could see that we had one touch there, one touch right there. There's probably definitely some sell side in these prints as well as right here. So huge orders coming at the 494.50 level. And I would look at the 49.50 as an absolute key zone of resistance as we move up into those prices, especially next week into OPEX. Now let's have a look at the charts. Now looking at the SPX, something I do want you guys to keep notice of is that the SPX moves higher upward while the advanced decline line moves lower. So still a bit of negative divergence in stocks moving higher and stocks moving lower. What we do want to see, however, is this moving up, and we are on that trend there, but we do want to break above these highs right there. That would be healthy. With that being said, if we actually go ahead and look at the trade we did today, and yeah, this looks bullish. I mean, you look at this as a whole and this is bullish. We're making highs and we're closing at the highs pretty much every day, a couple of times a week, and it's been very, very consistent. And you can't really look at this and say anything else other than the fact that it is bullish, at least not until, you know, we retest the waters here. You know, on Monday's video I said we will look for constructive downside action if we break below this level. We did not. We just keep moving higher and chugging along on the back of tech, comm services, and healthcare. Now, one thing I do want you guys to note is that after hours, yields are actually falling quite significantly, especially in the long end. You know, look at the 30-year, look at the 20-year, look at the 10-year. They did rise on the day, however, but they are falling in after hours. And if you look at the actual 5-minute chart, it was a gap up and go. We had the 10-year treasury auction. After that was a really good auction, and we didn't break the day's lows, didn't close the gap, and just moved higher. And I think if tomorrow's 30-year auction goes really, really well, we continue to move higher on the back of just a better economic outlook. And then looking at let's have a look at the weekly chart. And again, look at that, super strong on the weekly. There's nothing you can really say. There's no technical damage on this chart, and the same is true for the monthly. Pretty much on both the weekly and the monthly, we're closed at the highs, and if we close the week there, that's going to be very, very constructively bullish. I've seen a few posts on Twitter saying this could be like a double top, a higher high double top, and we come down. I really don't think so. What we do want to look for is sell side into February, but what targets am I looking at for us to go retest? At the absolute most, it's like 4,600 is what I'm looking at if we do sell into February. But realistically, what I'm realistically looking at is if we do get like that OPEX sell, we probably go into this area right here. That's probably it, you know, pull back into here and then higher price action into 5,100, 5,200, March, April, May, June. We'll take it one day at a time. This is where we are right now. Everything points to higher price action, and you just can't be bearish with the chart looking like this. Data in the week ahead, guys. So tomorrow, not much data, but we got initial jobless claims, continuing claims, and then we do have a 30-year bond auction. A lot of people are going to be watching this. Fed Barkin is speaking, and then Friday, these are the data points. Not much at all. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video. Cheers.